Let's talk about one of the most frustrating things in trading. You know the feeling, you spot a perfect breakout, it looks like it's about to make a huge move, and then, bam, it slams right back in your face. Today, we're going to crack the code on how to stop falling for that trap. Seriously, we've all been there, right? You see the price shoot past a key level, you jump in, your heart starts pounding, and then, just as fast, it reverses. Your stop loss gets hit, and you're just sitting there wondering, what on earth just happened? It is such a classic, painful trap. So, what's actually going on here? Well, it has a name. It's called a false breakout, or sometimes a bull trap. And really, you can just think of it as a fake out. It's a move that looks totally legit, but it just doesn't have the real buying power behind it to keep going. It's basically designed to fool you into thinking a new trend is starting, right before the floor falls out. And hey, this isn't some small, obscure thing. Check out this chart of the Facebook IPO. The hype was absolutely off the charts. The stock opened high, it broke out, and then it completely cratered. It is a textbook example of how even the moves everyone is watching can turn into a massive trap for traders who aren't prepared. It's really easy to just shrug this off and say, bad luck, or the market is just random. But you know what? Most of the time, it's not random at all. There is a very specific reason why this happens, and it's something you can learn to spot. And it all boils down to one crucial word: liquidity. See, the big players, we're talking hedge funds, big banks, they need to fill gigantic orders. And to buy, say, 1 million shares of something, they need to find someone else who's willing to sell 1 million shares. And guess who that often ends up being? Us, the smaller retail traders. So here's exactly how the trap gets set. We, as retail traders, do the responsible thing, right? We place our stop-loss orders at really obvious, predictable levels. The big players know this. They know exactly where those stops are clustered. So they can push the price just far enough to trigger all those sell orders, which creates the liquidity they need to fill their huge buy orders. Once they've gotten what they needed, the buying pressure is gone and the price just snaps right back down, leaving all the breakout traders holding the bag. It's a classic stop hunt. Okay, so here's the good news. While you're never going to avoid every single trap, that's just not realistic. You can absolutely learn to filter for the really high probability setups. You can start to shift the odds way more into your favor just by looking for a few key signs. And that's what we're going to do today. We'll start with the breakout trap itself, then we'll dive into our 3 filters: consolidation quality, risk versus reward, and stop loss placement. And at the end, we'll wrap it all up into a simple breakout checklist. All right, our very first filter is all about consolidation quality. Think about it this way. Before a rocket launches, you need a stable launch pad. It's the same with a stock. The price action before the breakout tells you a whole story. So we have to ask, is this foundation solid or is it kind of shaky? A really strong, high-probability breakout almost always comes from what we call a quiet base. Take a look at the stuff on the left. That's what we want: tight, sideways price action, low volatility, below average volume. It shows the stock is just calmly coiling up, building energy. Now look at the right side. That's the stuff you want to avoid. Noisy, choppy, erratic price swings, big jarring spikes in volume. That's not a sign of calm accumulation, it's a sign of a battle, of uncertainty. And that's not a solid launch pad. And here is a beautiful example of what I'm talking about. Look at the price action inside that box on the chart. See how calm and sidewise it is? The candles are tight. That is a constructive, quiet base. And that's the kind of foundation that can lead to a really powerful, sustained breakout, which is exactly what ended up happening. Okay, moving on to filter number 2, risk versus reward. Look, even if you find the most beautiful chart pattern in the world, the trade might not be worth taking if the numbers don't add up. Trading is a business. You have to ask yourself, does the math on this trade actually make sense? And the rule here is really, really simple. It's non-negotiable. We are only looking for trades where our potential reward is at least 2 times our potential risk. A 2-to-1 ratio is the absolute minimum. If you take trades with less than that, the long-term math just won't work in your favor. So how do we figure this out? It's actually super straightforward. Your risk, that's just the distance from where you get in to where you set your stop loss. Your potential reward, that's the distance from your entry all the way up to the next major area of resistance. The next price level where sellers are probably waiting. If that reward isn't at least double your risk, you just pass. You wait for a better opportunity. Simple as that.
This brings us to our third and final filter, and trust me, this one is a game changer. It's all about stop-loss placement. And more specifically, it's about understanding where everybody else, the herd, is putting their stops and why you need to be smarter than that.
You've heard this 1,000 times, I'm sure. The conventional wisdom says, oh, just put your stop right below the big candle that broke out. And it sounds logical, right? If the breakout fails, you want to get out quick. The problem is, that very logic is what makes you a sitting duck. When you place your stop in that obvious spot, you become a perfect, predictable target for the exact liquidity grabs we were just talking about. You're basically putting a giant take my money sign right where the big institutions expect it to be.
So what's the smarter move? Well, instead of putting your stop right below the breakout candle, look back into that consolidation range. Find the last real significant swing low inside that base, and put your stop just below that. Why? Because this gives the trade room to breathe. It protects you from that classic retest of the breakout level that so often happens. Your stop is now safely outside that immediate noise zone. Okay, so we've covered our 3 filters. Now let's pull it all together into a really simple, practical checklist that you can run through before you even think about placing a breakout trade.
Here it is, your 3-question pre-flight checklist. Before you hit that buy button, you ask, number 1, is the consolidation quality good? Is that base quiet and constructive? Number 2, does the math work? Is my potential reward at least twice my risk? And number 3, where's my stop? Is it placed smartly, below the prior swing low, away from that obvious trap zone? If you can't say a clear yes to all 3 of those, it's not a top-tier setup, and you're probably better off just keeping your cash and waiting for the next one.
Because ultimately, using a checklist like this forces you to answer the most important question of all. Are you actually trading a high-probability setup based on a clear plan, or are you really just gambling on a hunch and hoping for the best? By applying these filters, you move from hoping to planning. And that right there is the difference between just guessing and trading with a genuine edge.